Numbers don't panic, people do. Let's look at the psychology driving today's market. You bought the thesis, you believed in the position. Now the market is telling you something different, and something inside you refuses to listen. That refusal is not random. It is not laziness. It is a predictable psychological response to a specific kind of discomfort, the tension between what you believed and what is actually happening. The question is not why individual investors deny uncomfortable market signals. The question is what happens when that denial operates across an entire market and delays the correction that reality demands. There is a well-established concept in psychology called cognitive dissonance. It describes the discomfort you experience when you hold two contradictory beliefs or commitments at the same time, and the pressure to resolve that discomfort. In markets, this dissonance takes a specific form. You committed to a position based on analysis. The market contradicts your analysis. You now face a choice between accepting the loss or defending the belief. Most of us defend the belief, not because we lack intelligence, but because the discomfort of being wrong is psychologically harder to bear than the cost of holding a losing position. The observable pattern is familiar to anyone who has watched investors during a downturn. Positions that should have been exited are held. Evidence that should prompt reassessment is dismissed or reinterpreted. From a psychological perspective, this is not irrational in the way it appears. The investor is not ignoring the information. They are processing it through a filter designed to protect their existing belief. The belief is not just an opinion, it is a commitment. The investor spent time, effort, and capital building the position. Admitting the position is wrong means admitting the decision was wrong. And that admission creates dissonance. The mind resists it. Instead of accepting the loss and updating the view, the investor searches for reasons the original thesis might still be correct. This is where psychology intersects with market structure. When many investors hold losing positions and resist corrections simultaneously, the aggregate result is delayed repricing. The market stays misaligned longer than the information warrants. The denial is not just personal. It can become a collective condition. When enough participants share the same dissonant belief, the shared resistance to correction becomes visible in the price. Festinger described cognitive dissonance as the psychological discomfort from holding contradictory cognitions. People reduce this discomfort by changing beliefs, adding consonant elements, or reducing the importance of the conflicting information. In the investment context, changing the belief would mean admitting the position is wrong. Adding consonant elements means finding new reasons the position might still be right. Reducing importance means dismissing the conflicting data. Notice the distinction. The investor is not uninformed. They have the data. But the data creates discomfort, and the mind resolves the discomfort by reinterpreting the data rather than acting on it. This reinterpretation takes several predictable forms: selective attention to confirming evidence, dismissal of contradicting signals, shifting the timeline of the thesis, blaming external factors for the temporary deviation. Schifrin and Statman identified a related behavioral pattern called the disposition effect. Investors tend to sell winning investments prematurely while holding losing investments far too long, consistent with cognitive dissonance and regret aversion. The link to dissonance is clear. Selling a winner confirms you were right. Selling a loser forces the admission that you were wrong. The dissonance of being wrong keeps the position open. But the disposition effect has multiple contributing factors beyond cognitive dissonance alone. Regret aversion, mental accounting, and loss aversion also play roles. The behavior is not reducible to a single bias. So cognitive dissonance is one contributor to this pattern. It operates alongside other psychological forces to produce a systematic tendency to resist the very information that would lead to better decisions. Here is the feedback loop. An investor forms a thesis and commits capital. The market moves against the thesis. This creates dissonance between the commitment and the evidence. To resolve the dissonance, the investor does not exit. Instead, they reinterpret. They find new justifications. They dismiss the contradicting signal. They extend the timeline for when the thesis will be proven right. Each act of reinterpretation deepens the commitment. The investor is now defending not just the original position but all the reasons they invented to keep it. The dissonance grows with each layer of justification. Research indicates that increasing the level of dissonance can intensify this effect. Reminding investors of their earlier reasoning for a purchase can cause them to hold losing positions even longer. This means the very act of explaining why you are in the position can make it harder to leave. Articulating the thesis reinforces it. The explanation becomes a trap. When this dynamic operates at scale, it can affect pricing. If enough investors are resisting correction on the same asset or sector, their collective denial can delay the repricing that the evidence would otherwise produce. The delay creates an opportunity for further mispricing. During the period when investors resist the signal, the gap between price and reality can widen. When the correction finally arrives, it can be sharper. Emotion can amplify the move. The deeper the commitment, the stronger the dissonance when the market contradicts it. Investors who have publicly defended their thesis may experience the strongest resistance to correction. The structural dimension interacts here as well. Investors holding levered positions face not only psychological dissonance but financial pressure. The combination of dissonance and leverage can produce particularly extended delays before capitulation. Narrative plays a role in sustaining the denial. When a community of investors shares the same thesis, each member's continued commitment reinforces the others. The shared narrative becomes its own source of consonant information. This creates a secondary feedback. The investor looks to the community for validation. The community is itself composed of dissonant investors. The validation they provide is not independent evidence, it is shared denial. The confirmation bias compounds the dissonance. Investors selectively seek information that supports their existing position and avoid information that contradicts it. The filter narrows as the dissonance increases. At the extreme, the investor may construct an internally coherent narrative that is disconnected from external evidence. Contradicting data has been reinterpreted, dismissed, or absorbed into the defense. When the denial finally breaks, the exit can be sudden. The accumulated dissonance collapses. What was a gradual resistance becomes a rapid capitulation as the investor finally accepts the reality they had been defending against. So the mechanism runs from commitment to dissonance to denial to sustained mispricing. The correction is not prevented, it is delayed, and the delay can make the eventual correction more disruptive. But not every investor who holds a losing position is experiencing cognitive dissonance. Some have genuine long-term conviction based on fundamentals. Some have structural reasons that justify patience. Cognitive dissonance theory does not predict which investors will resist correction, how long the denial will last, or when the collective capitulation will begin. Individual differences in self-regard and experience moderate the effect. Consider that holding a losing position can sometimes be the correct decision. Markets overshoot. Temporary drawdowns occur. A patient investor with sound fundamentals may be vindicated by time. The distinction is between conviction and denial. Conviction holds because the thesis is supported by updated evidence. Denial holds because admitting the thesis is wrong creates too much discomfort. There are episodes consistent with this framework. When large groups of investors remain committed to a deteriorating thesis, and the eventual exit is sudden and concentrated, the pattern aligns with what dissonance theory would describe. But identifying this pattern after the fact does not make it a predictive tool. The boundary between justified patience and dissonant denial is often visible only in retrospect, so the thesis holds within boundaries. Cognitive dissonance can contribute to sustained mispricing by delaying correction, but the behavior is not purely psychological. It is one factor among structural and institutional forces. Which brings us back to the opening tension. Why do investors refuse to listen when the market contradicts their thesis? From a behavioral perspective, the dissonance of being wrong outweighs the cost of staying wrong. The commitment creates the dissonance. The dissonance motivates the denial. The denial delays the correction, and the delay can amplify the eventual repricing when the denial finally breaks. But this is not a complete explanation. Not all holding is denial. Not all delayed corrections are dissonance-driven. The line between patience and denial requires separating evidence-based conviction from discomfort-based resistance. The value of understanding dissonance is not in predicting the correction. It is in recognizing the psychological mechanism that delays it and examining whether your own holding is conviction or avoidance. Price is evidence of transactions, not a direct reading of emotion. A falling price may reflect temporary dislocation, structural adjustment, or the unwinding of collective dissonance. The price alone does not tell you which. What dissonance theory offers is a framework for understanding why correction can be delayed. It does not tell you when the delay ends, or whether the thesis will ultimately be vindicated. Awareness of your own dissonance does not automatically resolve it. The mechanism operates at a level deeper than conscious analysis. You can know the bias exists and still be subject to it. The collective dimension makes this more complex. Even if you overcome your own dissonance, other investors holding the same position may not. Their continued denial sustains the mispricing in which you operate. Cognitive dissonance is one lens through which to understand why markets resist correction. It does not predict timing or direction. but it reveals a mechanism that can keep prices disconnected from reality. Start by examining your own positions. When the market contradicts your thesis, ask whether you are updating your view based on evidence or defending your commitment to avoid discomfort. Ask whether you would enter the same position today with the same information at the current price. If the answer is no, the holding may reflect dissonance rather than conviction. Observe the behavior, not the prediction. When you see an entire sector resisting correction despite mounting contradictory evidence, consider whether collective dissonance may be sustaining the mispricing. Remember that recognizing the pattern does not give you a timing advantage. The denial can persist far longer than the evidence suggests it should, precisely because it is not rational. Compare the psychological explanation with a structural one. Is the correction delayed because of leverage unwinding, liquidity conditions, or institutional positioning? Psychology is not the only factor. Behavioral interpretation does not reliably predict when the denial will break or which direction the correction will take. It offers a diagnostic framework, not a trading signal. Cognitive dissonance reveals why being wrong in the market is harder than in most contexts. The commitment of capital makes the belief personal, and the personal makes the denial structural. The crowd creates the feedback. Studying how dissonance shapes collective market behavior is the first step toward understanding the pattern. This is educational analysis, not financial advice. When reality contradicts your position, the dissonance you feel is the mechanism that delays your response. Understanding that delay is the observation, not the prediction. Don't follow the herd, study it. See you next time.